VaR mapping is a technique used in risk management where we replace the individual values of many securities in a portfolio with a smaller set of common risk factors. Instead of tracking the risk of every single asset separately, we focus only on the main drivers that affect them, such as interest rates, stock prices, or exchange rates. For example, if a portfolio has 500 different stocks, we don't measure the risk of all 500 one by one. Since most of them move with the overall market, we can link them to a single equity market factor. This reduces complexity and makes risk measurement much faster and more practical. The need for VaR mapping becomes clear when portfolios get very large. Imagine a bank holding thousands of bonds, stocks, and derivatives. Calculating the risk of each instrument individually would take huge time and computational power. Also, some instruments change over time, like bonds whose maturity shortens or options whose sensitivities keep shifting. In cases like IPOs or newly issued securities, there may not even be enough historical price data available. Mapping helps because instead of relying only on past prices, we measure how these instruments react to common market factors, which still allows us to estimate their risk reliably. The key principle behind VaR mapping is aggregation and simplification. We convert each position into its exposure to a few basic or primitive risk factors. So rather than saying this bond has its own unique risk, we say this bond mainly depends on interest rates. If 10 bonds are all sensitive to interest rates, we combine them into one single interest rate exposure. The goal here is not perfect pricing accuracy, but a good approximation of risk sensitivity, which is enough for risk measurement purposes and much more efficient computationally. The process usually starts by listing all portfolio positions and recording their current market values. Then we identify the common risk factors that influence these positions, such as interest rate changes, equity market movements, or currency fluctuations. After that, each position is mapped to these factors using exposure weights. For instance, a stock may be fully linked to the equity factor, while a bond may be mostly linked to interest rate risk. We then sum all exposures factor-wise to get total portfolio exposure. And finally, we feed these totals into the VaR model to estimate the potential loss under different market scenarios. In the end, VaR mapping turns a complicated portfolio with hundreds or thousands of securities into just a few clear risk numbers. For example, instead of managing 1,000 separate trades, a risk manager might only track 3 exposures: equity risk, interest rate risk, and currency risk. This makes simulations quicker, results easier to interpret, and decisions much faster. That's why VaR mapping is such an essential tool in modern risk management, because it simplifies complexity while still capturing the true drivers of portfolio risk.